Did you know that small changes can lead to big financial results? This simple sentence summarizes the key to transforming your financial life. But for that to happen, you need to understand how to make your money work for you. I'm not talking about magic, but a process that, when followed in a disciplined manner, can lead you to a level of financial freedom you might never have imagined. In today's video, we will explore a clear and direct step-by-step guide to help you start making your money work for you without needing to be an investment expert. We'll talk about how to organize your finances, invest wisely, and take advantage of the power of time and compound interest. I have already helped many people achieve real results with their finances, and what I'm about to share with you could be the first step toward a more secure and peaceful financial life. Do you also feel like you work hard but can't save enough? This is a common reality for many, right? You're trying, doing your best to pay the bills, but it seems like the money is never enough to reach your financial goals. Many of us were taught to work hard for a fixed salary, but no one ever taught us how to make money work for us. Maybe you've heard of financial independence, but wonder, how do you get there? And where do you start? The challenge is great, but the good news is that there are ways to achieve financial freedom, and it all starts with a change in the way you handle your money. Before investing, it's crucial to understand the basics, having strict control over personal finances. This means having a budget, eliminating debts, and starting to think about an emergency fund to protect yourself against unexpected events. By organizing these basics, you create the foundation necessary to start growing financially. In the next step, we will talk about the importance of investing with confidence. Let's understand together how you can start, even with little money, and how this can completely change your financial trajectory. Now that we've identified some of the financial challenges many face, it's time to present the solutions. In today's video, I'm going to share with you 6 essential steps that can transform the way you handle your money. First, we will talk about the importance of organizing your personal finances. Without this, it's difficult to move to the next level. Then, we will discuss how to start investing with confidence, even if you don't have a large amount to begin with. We'll explore the power of compound interest and how time can be your best ally in the wealth-building process. Next, we'll dive into the world of passive income and how you can invest in assets that work for you, generating consistent profit. And to sustain your growth, we'll discuss the importance of maintaining discipline over the long term and reinvesting your profits to accelerate your progress. With these steps, you'll be on the path to making your money work for you. The first step to making your money work for you is essential: organize your personal finances. Before thinking about investing, you need to understand how you are handling your money on a daily basis. And for that, the first item on the list is to create a personal budget. Have you ever stopped to think about where your money is going? Often, without a budget, we end up spending impulsively and don't realize where the money is being consumed. This can be solved with tools like Mint or Anab. You Need a Budget, which are very popular in the US. They help organize your finances, track expenses, and ensure that you have a clear view of where your money is being spent. Also, controlling your debt is another crucial point. Debt can be a major obstacle to achieving your financial goals. Therefore, it's important to have a plan to pay off those debts as quickly as possible, especially high-interest debts like credit cards. The less debt you have, the easier it will be to invest and build wealth. In the US market, an important point is your credit score. This number directly influences your ability to get loans, mortgages, and other financing. Having a good credit score can save you money on interest and open doors to better financial opportunities. To improve your score, pay your bills on time, keep your credit utilization below 30% of your limit, and avoid opening too many credit accounts in a short period. But before starting to invest, it's essential to have an emergency fund. This means saving 3 to 6 months of basic expenses to cover any unexpected events, such as job loss or unexpected healthcare costs. This fund provides the necessary security so you can start investing with more confidence, without worrying about financial emergencies. Immediate action: do a full review of your finances. Open an app like Mint or Anab, organize your budget, and set clear goals to pay off debt and create your emergency fund. This will be the foundation that allows you to invest more securely in the future. Now that your finances are organized and you have an emergency fund, it's time to take the next step: start investing with confidence. Even if you don't have a large amount to invest, the important thing is to start. The key to building wealth in the long run is to invest regularly, in a disciplined manner, and know how to choose the right options for your profile. In the US, one of the most popular options is stocks, which represent ownership in companies and can offer significant returns over time. You can buy shares of companies you believe will grow, like Apple, Microsoft, or other large corporations. In addition, there are index funds, ETFs, which are an excellent way to invest in a diversified portfolio of stocks with a single investment. They can be an interesting option for those who want to be exposed to the stock market without having to choose individual stocks. The famous S&P 500, which includes the 500 largest companies in the US, is a popular option and has historically delivered good results. Another option is bonds, which work as loans to the government or companies. While they offer lower returns than stocks, they are considered safer and may be a good option for more conservative investors. If your profile is more conservative, you might prioritize bonds to ensure more security in the short term. And if you're thinking about the future, a great investment strategy is to contribute to a 401k or Roth IRA. The 401k is an employer-sponsored retirement plan, very common in the US, and often includes an additional contribution from the company. The Roth IRA is a retirement account that offers important tax benefits. You invest with after-tax dollars, but the money grows tax-free, and you don't pay taxes when withdrawing the funds at retirement. These types of accounts are ideal for those thinking long-term. If you have the opportunity to participate in a 401k plan at your job, take advantage of it, especially if the company offers a matching contribution to your retirement fund. Immediate action: if you haven't started investing yet, open an investment account with a brokerage or through your employer for a 401k. Choose an index fund, ETF, or bond, depending on your risk profile, and start contributing regularly. Benefit: by investing consistently, you will be making your money work for you. And over time, you'll see how small investments can turn into a large fortune, thanks to compound interest and the power of time. Now that you've started investing, let's talk about one of the most powerful concepts in the world of finance: compound interest. It's often called the eighth wonder of the world by people like Albert Einstein, who recognized the impressive impact that compound interest can have on growing your wealth. But what is compound interest? Simply put, it's the interest you earn on the interest. In other words, when you invest, the return you receive is added to the invested amount, and in the next period, you earn interest on this larger amount. Over time, this process creates a snowball effect, where your investments grow faster and faster as the interest accumulates. This is why it's so important to start early. The sooner you start investing, the more time your money will have to grow. For example, if you invest $100 per month in a fund with an average return of 7% per year, over 10 years, you'll have accumulated about $18,000. And if you keep investing for another 10 years, that amount could grow to about $40,000, simply because compound interest makes your money multiply exponentially. You don't have to be a big investor to take advantage of the power of compound interest. By investing small amounts regularly, like $50 or $100 per month, you can see your wealth grow significantly over time. This is the secret of the most successful investors in the world. Warren Buffett, for example, is a huge advocate of the power of time and compound interest. He started investing at a very young age, and over time, his investments grew significantly, largely due to the impact of compound interest. Time is another crucial factor. When you start investing and let your money grow over the years, it has more time to multiply. This means that even if you don't have a large amount to invest initially, the key is to be consistent and start as soon as possible. Time in the market is much more important than trying to time the market. In other words, don't try to guess when the best time to invest is. The ideal is to start and keep investing over time, without worrying about timing the exact moment. Investing early and consistently allows you to make the most of compound interest, and even if the initial amount invested is small, the cumulative effect over the years can be extraordinary. Now that you understand the power of compound interest and how time can accelerate the growth of your wealth, it's time to talk about how to invest in assets that generate passive income. This is one of the most important pillars for making your money work for you. Passive income is the income you receive without needing constant effort to generate the earnings. In other words, you put your money to work, and it starts to generate more money without you needing to be actively involved in the process. One of the most common ways to generate passive income is through dividend-paying stocks. Dividends are payments made by companies to their shareholders, usually on a quarterly basis. Companies like Coca-Cola, Procter & Gamble, and Johnson & Johnson are known for paying regular dividends. When you invest in these stocks, you receive a portion of the company's profits without needing to sell your shares. Over time, these dividends can accumulate and provide a steady source of passive income in addition to the appreciation of the stock price. Another option is REITs, real estate investment trusts, which are real estate funds. REITs are a way to invest in real estate without needing to buy physical properties. These funds invest in commercial, residential, or even healthcare properties and distribute profits as dividends to investors. Investing in REITs offers a way to gain exposure to the real estate market and obtain consistent passive income without the complications of managing physical properties. Real estate investments, by themselves, are also an excellent way to generate passive income. Buying rental properties can be a powerful strategy since you receive monthly income through rent. However, it's important to remember that managing properties can require more time and effort, especially if you don't hire a property management company. However, if you don't want to deal with managing physical properties, REITs are an interesting solution as they provide access to the real estate market without the day-to-day complexities of property management. In addition, REITs generally offer a high dividend payout, making them an excellent choice for those seeking passive income in a simpler way. In addition to stocks and real estate, another alternative for generating passive income is peer-to-peer lending platforms, where you lend money to individuals or businesses in exchange for interest. While this type of investment carries more risk, it can provide attractive returns, depending on how you manage your lending choices. Investing in assets that generate passive income is a way to create a constant source of money working for you. Over time, this passive income can become an important part of your wealth-building strategy, allowing you to focus on other areas of your life while your money continues to grow. Now that you have a solid understanding of how to invest in assets that generate passive income, the next crucial step is to maintain discipline and focus on the long term. This is one of the most important factors when it comes to investing and building wealth. Often, beginner investors may be tempted to make impulsive decisions based on market fluctuations or short-term rumors, but this mentality can be harmful in the long run. The stock market can be volatile. In some years, we may see significant appreciation, while in others, the market can drop. This is completely normal and is part of the economic cycle. In 2008, for example, the global financial crisis caused many people to lose money in financial markets. However, those who remained calm and did not sell their investments during that crisis period saw the markets recover in the following years. Investing with a long-term focus means not being swayed by temporary market drops. Instead of trying to time the market and sell when it drops, it's smarter to stick to your strategy and trust that, over time, markets tend to recover and generate growth. Discipline also involves resisting the temptation to spend instead of investing. We know it's easy to spend on small indulgences, but remember that every dollar you spend today is a dollar less working for you in the future. The practice of delayed gratification is something many successful investors, like Warren Buffett, have embraced throughout their careers. Buffett has always spoken about the importance of being patient and investing with a long-term outlook, rather than seeking quick returns. This mindset has helped him accumulate a fortune of over $100 billion throughout his life. Staying focused on the long term also means avoiding following financial fads. The market is full of promises of quick returns and speculation, but most of the time, these strategies are not sustainable and can lead to significant losses. When you adopt a solid, long-term investment strategy, like investing in good company stocks, index funds, or real estate, you are building a stable and sustainable foundation for the future. Remember, investment success doesn't come from a series of short-term decisions, but from consistency and patience. Investing in a disciplined and consistent manner, without worrying about the market's ups and downs, is the key to achieving financial independence. Now that you understand the importance of maintaining discipline and focusing on the long term, it's time to talk about one of the most powerful strategies to accelerate the growth of your wealth: reinvesting your profits. When you start generating profits from your investments, like dividends from stocks, income from real estate, or interest from bonds, it's essential not just to be content with these earnings, but to reinvest them intelligently. The process of reinvesting profits is one of the most effective ways to exponentially increase the value of your portfolio over time. A classic example of how this works comes from the concept of dividend reinvestment plans, DRIPs. Many funds and companies offer DRIPs, where dividends paid to investors are automatically reinvested into the purchase of more shares of the company, rather than being paid in cash. This creates a growth cycle where dividends become a source for generating even more dividends. This process may seem small at first, but over time, it creates a compounding effect and can make your investments grow much faster and more significantly. For example, let's imagine you invested $1,000 in a stock that pays a 4% annual dividend. Instead of withdrawing the $40 in dividends, you choose to reinvest this amount by purchasing more shares. The following year, you not only received the 4% dividend on your initial $1,000, but also on the additional $40 you reinvested. Each year, this process repeats, and your dividends begin to accumulate exponentially. This strategy has been widely adopted by great investors like Warren Buffett. He is known for reinvesting his profits into his own companies or other investment opportunities. Buffett, through his holding company Berkshire Hathaway, has consistently applied the strategy of reinvesting profits to fund the growth of new businesses and acquisitions. This continuous reinvestment process has been crucial to his massive fortune over the decades. Reinvesting your profits also means that as your investments grow, you have a larger base of assets that, in turn, generate more earnings. This creates a virtuous cycle of growth. Instead of being content with the initial profits, you're building a continuous growth machine that works for you more and more efficiently. Moreover, by reinvesting your profits, you're expanding your portfolio without needing to add new funds from your pocket. In other words, you can increase the value of your wealth automatically, taking full advantage of the power of compound interest and time. Conclusion: reinvesting your profits not only accelerates your growth, but also ensures that your money continues working for you. If you're aiming for financial freedom and a more secure future, make sure to apply this strategy. The more you reinvest, the faster your money will multiply.